David, we've been receiving quite a few questions, and I see someone's looking to put you on the spot right now to say top 5 stocks to choose now for the recovery.
Me?
Yeah.
I'm got my top stocks are in the. I like the FANGs. I think they're going to come out as big winners from this. I'm trying to think what else we've been following. I think on the health side, big pharma is going to benefit. I'm not sure which ones. We've gone more into the medical technology side, electronics, intuitive surgical, all those businesses. I think Johnson & Johnson, we've seen how they've run on the announcement that they've got a candidate for a vaccine. I don't know what that means. Obviously, they're making progress towards that. But I think those are the kind of businesses that are going to benefit significantly from that. So I still like the FANGs. I think Amazon, Apple, Alphabet. I'm trying to think which are. Netflix come out. Disney has been killed, and not sure why. I think mainly because theme parks are being closed and that. But that presents a great opportunity. And of course, air travel's taken a big crunch. So shares like Airbus, which I know are under a bit of pressure in the short term, but they've got a 10-year order book. None of their orders are being cancelled. So there's so many opportunities that we can, look at. Happy to give more.
David, just on looking at a lot of the questions, there seem to be a lot of South African-focused questions, specifically on banks coping, liquidity constraints within the SA government, etc. And just looking at sort of the capital liquidity positions of the banks, of the government, etc., to get through this period.
Interesting. We've seen that the UK, I don't know whether they've recommended it or ordered, but they're asking banks not to pay dividends. Maybe I'm being polite, in other words, to conserve cash just in case there is a credit crunch, just in case the banks need the money to finance businesses, which is more important than passing it on to shareholders. So there's a postponement of that. We discussed it this morning in our meeting, whether it applies to local banks. Local banks will probably pay the dividends for the period to the end of December for that period. But I think thereafter, they might also be reluctant to let cash go. They're in a good position. The one thing that I didn't mention is that banks, unlike any other crisis, this has not been a banking crisis. Our banks or global banks are in pretty good shape, particularly American banks, well capitalized and certainly not under any kind of threat. But I think there is a duty or an obligation for them to conserve cash just in case coming out of this crisis takes a little bit longer, and therefore they will hold back on actually passing cash. Errol, there's one question. I think this comes from another discussion we had. In the case of preference dividends, will they hold back a preference dividend? Remember, a preference dividend, preference shares are equities. They are not loans, and therefore they classify it as equity, and they rank just higher than ordinary dividends. I'm not sure. I'm not sure what banks will do. We'll have to watch that to see whether they hold back on that as well. And what's a little worrying is that most of the preference shares issued on our market are non-cumulative. That means that if you skip a dividend, it doesn't mean that you have to make it up. So that's a question mark that we have to go into.
I'm going to jump around a little bit, David, but I picked up a question here specifically around the dollar in all of this as a safe haven currency, and then just a view on the rand. I know that's an impossible call, but just a question around the rand possibly reaching its ceiling in the short term.
Oi, no one knows. I think the dollar remains very strong at the moment, mainly because of its safe haven status. And I think even the dollar strength has surprised us, but it shows you that people want to go into the dollar at times like this. And it also can be around the purchase of dollar bonds, of US treasuries, believing that they're going to be strong enough to get through this particular crisis. The rand has been under pressure for some time. And I think we can't ignore the predicament that the South African economy is in at the moment. What you do find, and this is where the challenge is that at times like this, if the market does recover, if we start to see share prices picking up, the rand will improve with that. Pressure will come on the dollar, or people will start selling out the dollar, going into what we call risk assets, going into equity markets, and the dollar will start to show, the rand will start to show improvement. In fact, at one point, I think not even a week ago, the rand was all the way down back at about 17.20. And it's only in the last couple of days. In fact, I don't even know if it's days or hours. You lose track of time. We're back at 18.20 at the moment. So calling the rand it's virtually impossible. The volatility is impossible. But if we get on top of this crisis, if we get on top of it, the rand will improve. And even taking into consideration the predicament that we find ourselves in. Long term, though, the rand remains on a weakening bias.
Sure. I suppose, David, just to mention though that for a lot of our clients who are invested offshore with us, in these turbulent times, the rand depreciating for a rand investor has been providing somewhat of a buffer or a hedge against that, because typically when you have all this turmoil, you have this risk-off trade into the rand, and it creates that. So as you see that improvement, I would agree with that. I see this on the oil war as well, been a very big topic. Of March.
Which one? Sorry, which one was that?
The oil war. So basically, OPEC and what's happening in that market.
That actually was a straw that broke the camel's back. Markets were holding up pretty well, maybe incorrectly. I'm not saying that they wouldn't have fallen after that, but that came as a major shock. And for the meantime, there's a glut of oil. There's, even with President Trump trying to intervene between the Saudis and the Russians to try and get some normality there, and I see the oil price did pick up slightly now. If you read between the lines, there's a glut of oil, and this could head, we could see an oil price of anywhere near $10. We don't know where it's going. I think probably what we can say is that it's probably more likely to get to 10 than it is to 60 at the moment. So it's very, very difficult to understand what's driving the market, what's driving the oil, or what will drive it. Erol, I've got a point, because I was brought up in the De Beers era, where De Beers, the Central Selling Organization, the CSO, they try to control the price of diamonds by limiting supply, and by limiting supply into demand. And in the end, all cartels fail. And I mean, oil is a cartel. It came to the fore in the 1970s. We had the first oil crisis there in about 1973, which sent inflation through the roof. You weren't around in those days, Errol, but ever since then, there's been a control. The Middle Eastern nations, or the big, powerful producers, have controlled it. All of a sudden, we're seeing a collapse of that cartel, and probably we're getting to an oil price closer to where it should be. I think the negative side of it is that there are a lot of oil-producing nations who need a much higher oil price, and this is the downside of it. We can even talk about the frackers. In the US, I'm not sure how it's affecting them in this situation. So, and there are a lot of businesses, the oil, service businesses, that are under a lot of pressure. But it was the price war between the Saudis and Russia that actually, sent markets down a lot further than we anticipated, and caught us completely off guard. Where it's going to, I just watch it.
Sure. I suppose what's clear is there's a huge oversupply in the market at the moment, and unless they get the act together, that's going to continue for a little while. Then, David, just also, quite a few questions around the downgrade and impacts across bonds, currency, interest rates, etc. It's come, it's obviously come at an interesting time, and we have quite a few questions. So I'm not going to sort of articulate what the different nuances in the questions are, but perhaps just a general view around the downgrade at this point.
When you introduced me, you said that we're going to do more of these. And I think we probably, listen, I'm an accountant. I'm not even an economist. I know cash books is probably the full extent of my knowledge. I know cash going in and cash going out. When it comes to economics, I'm a bit weak in this area, and especially when it comes to bonds. But I think from that point of view, we pushed ourselves into the corner. We were going to be downgraded whether COVID-19 came or not. So I think we have to accept it. If you read through the Moodys statement, they spoke about the problems in the Zuma era. How we had the profligacy, the state capture, and other issues that pushed us to where we are now. And now we find ourselves having to get out of it in a particularly difficult time in the global economy. In essence, it could be a blessing that we actually have to reset or push the reset button on the South African economy and take a much closer look at how we can get it with the cooperation of everybody. So don't brush this aside. We're in for a very, very hard time. And one of the difficulties comes largely because of where we've been positioned. South Africa, we've been a raw material producer. We still make a huge amount of our money from digging things out the ground and sending them to other people around the world to make use of it. Whether it's coal, whether it's iron ore, whether it's platinum, whether it's palladium, whether it's manganese, and so on. That's, to a large extent, that's provided us with a foreign currency and also a huge number of jobs associated with mining. We find ourselves in a particularly difficult environment now because of the slowdown. Commodity prices have come down, demand has come down, and that's also exposed weaknesses. So we've got to kind of, when I say reset, we've actually got to look at these industries and we've got to reposition them for where the world economy is at the moment. We've also got to be a lot more liberal in attracting investment at the moment. We can't put obstacles in the path in the way of people who actually want to come in here and invest money in it. And we need that investment now. So I think there's so many elements about this economy that we have to relook at, and hopefully government take up the challenge and start to restructure it or start to ease off on so many of the requirements that have actually left us where we are at the moment.
Yes, David, I think, just for the benefit of the attendees, we are certainly planning as part of the series to have a special fixed income presentation by one of our fixed income experts, where I think we can get a lot deeper into these sorts of details. I suppose also just to mention that, the challenge for South Africa with this downgrade and with what bond rates have done, or bond yields have done of late, is that we have very high debt to GDP levels, and we don't really have the fiscal firepower in terms of the economic reality that we face in this COVID-19 situation. So the cost of funding is increasing, and this is a challenging environment. So it is material, but we have also seen the central bank, etc., stepping in South Africa, starting to make the right noises. So I think it's going to be a very important space to watch.
Just Erol, on bond rates have held up remarkably well. If we consider where we are at the moment, I think there was a fear that there would be a knee-jerk reaction and bond rates would go through the roof after the downgrade. In fact, they've improved quite a lot. So even talking to Phil Bradford this morning, or discussing it this morning, yes, we're going to be kicked out of the bond funds. But I think most of the people in that position in those funds have already positioned themselves. So I don't think there's going to be a major shock when the MSCI bond funds and the various other global bond funds actually force their way out of South African bonds. I think to a large extent, it's probably in the market already. So it might be an opportunity. Bond yields at these levels might be a fairly good buy. So yeah, it's where they 11. I don't know where I don't know though that market very well. I don't know the R8, the 186s are 7 years, but the 10-year is around about, I think, 11 or thereabouts percentage. It's not a bad rate, because even if you pay full tax on that, you're coming out with a rate of 5 or 6% and inflation is going to come down, you're still going to get a pretty good, real yield. But once more, I'm an equity man, so please just be very careful about taking my advice on the bond market.
No, I agree, David. I think, it's important to mention that, a country like Brazil was trading at much stronger yields than South Africa before COVID-19 and before the downgrade, and they were already a few notches below investment grade. So the market certainly was already pricing this in before all of this started. Just picking up, I see there are some questions around timing on rotating out of SA into global offshore. Is this the right time, etc.?
It's one of those very, very difficult situations. When the Rand was 14 and we tried to encourage people to take money out, they said, no, I want to wait for it to be 13.50. I want it to go back. When it got to 15 and 16, we said, take the money out. No, we want to wait to get lower. So it's a difficult situation. What happens, and I tried to say this earlier, what will happen is that, yes, while the Rand might come down, you'll miss the kick up in the equity market. They go together. So you must decide where to position yourself. Telling you when to take money out and go into global markets or look at it is so difficult. I think the best way and the most conservative way is to do it in tranches. In other words, take little bits out, a third, maybe 40%, 30%, 30%, something like that. But you don't want to miss the market on the other hand when things do turn around. And I promise you, they are going to turn around. What else?
David, a slightly more difficult one here. I just see, no one's disputing a global recession, but any view on the probability of a global depression?
That's hard. I think the governments, when I say governments, I'm talking every government wants to avoid a global depression. That leads to mass unemployment, and you get into a downward spiral that you can't reverse. I'm not a scholar of the 1930s. I wasn't there yet. I wasn't on the market at that stage. I came a little thereafter. But nobody wants a repetition of that. There were fears in 08, 09 that we could go into a depression. And that's why we introduced, and Bernanke came in with unconventional methods of stimulating the economy. That's when we saw for the first time QE. This time they were so scared of it. Whatever Bernanke introduced in 08, 09 has been introduced now to the power of 10. So they're putting a lot more and have promised a lot more, being pushed into the system to ensure that this doesn't happen. We will only see it when we come out of this and to see where businesses are. But I think that the last thing that governments want is to go into a depression. So they will keep stimulating more and more money, printing. That's what they do. Yes, 08, 09, everybody worried. We had all the intellects, we had all the the clever boys talking about inflation. We were dead scared of inflation. It was going to go through the roof. 10 years later, it's not there. So we only hope that we do get some kind of inflation. So I think similar methods are going to be applied now in order to avoid going into that kind of situation.
David, I think we probably have time for sort of one more. I just see that there are quite a few questions coming through around the local market, around listed property, SASL, buy or sell, opportunities within the local market. Just maybe a few views, just focusing on local as a final question.
Yeah, local's difficult, and from my point of view, I find they're going to be trading opportunities. If you've got a trading mentality, there's no doubt that there will be a bounce in our market. The problem is it sustainable? Can it continue? My philosophy and our strategy is always to look 5 years hence and say, where will this business be 3, 4, 5 years down the line? Will it still be there? And I like to apply that kind of method to choosing where we go. And the problem is that when we look at the South African economy, and we know we're going to go backwards this year, we know that the next 2 to 3 years, we're not going to see any growth or anywhere near, even if we do come out of contraction, if we do expand, it's going to be at a very low level. So it's hard to read which businesses will prosper in a situation like that. We've been very careful. We stuck with those that have got international exposure. I think Naspers and Prosus stand out. The banks will be secure; they'll still do pretty well, and all credit to them for for the position that they're in, and also to Treasury for maintaining the banks and carefully looking at them. And you know that from being at Sasfin, you know what compliance is like, and how the Reserve Bank are constantly on you. So I think banks are in a pretty good position. Our insurance businesses, all of those businesses are pretty reasonable. They are suffering as a result of a poor economy. So it's very hard to work out where they'll be. And again, I came back to a question that I answered earlier on the miners. How will the miners survive? Can they survive at these kind of levels? The one thing that we do have is incredibly good miners. And, if you look at where Impala is today, if you look at where Anglo Platts, and you look at our gold miners, regardless of the difficulties, they're still in strong shape. So we've got thank goodness, a very strong mining sector. Kumba, Assol, all those businesses are still in very, very good shape. So hopefully they'll pull themselves out of this.